When governments talk about your financial freedom, they use reassuring words. Stability, growth, opportunity, reform. It sounds responsible. It sounds protective. But if you slow down and look at history, a different pattern starts to appear. Again and again, governments have used financial mechanisms that quietly shift the burden downward while concentrating power upward. These mechanisms aren't new. They're not even creative. They've simply been recycled across centuries, renamed, repackaged, and presented as necessary policy. Let's start with the oldest method of all, inflation. When a government spends more than it collects in taxes, it faces a choice. It can raise taxes openly, which voters don't like, or it can reduce the value of the currency more subtly. Ancient Rome did exactly this. In the 3rd century, Roman emperors began reducing the silver content in their coins. The denarius, once nearly pure silver, slowly became copper with a thin silver coating. Officially, nothing had changed. The coin still said the same thing, but its value had quietly eroded. Prices rose, savings lost purchasing power, wages struggled to keep up. It was a hidden tax. Today, the mechanics look different. Instead of imperial mints, we have central banks. Instead of shaving silver from coins, we expand the money supply. But the effect is familiar. When prices rise faster than incomes, purchasing power falls. Inflation doesn't announce itself as a tax. It just behaves like one. The Middle Ages offered another version of financial pressure: forced loans. Kings in England, France, and Spain would request funds from wealthy merchants and guilds. Refusal wasn't really an option. These loans were framed as patriotic duty. Repayment, if it came at all, often arrived late or in devalued currency. The crown financed wars and palaces. The lenders absorbed uncertainty. Again, the structure was simple, obligation wrapped in language of loyalty. By the 17th century, the system became more sophisticated. When the Bank of England was founded in 1694, it was created to help finance war. Wealthy investors lent money to the state by buying government bonds. In return, they received interest payments funded by taxes. On paper, it was elegant. But think about the flow. The wealthy lent to the government and earned reliable returns. Ordinary citizens paid taxes on goods like salt, beer, and cloth to fund those interest payments. A structure emerged. Lending to governments became one of the safest investments available, and those returns were ultimately backed by the labor and consumption of the broader population. Fast forward to today. Governments run persistent deficits. Bonds are issued. Investors, banks, and institutions buy them. Politicians describe the spending as investment in growth, infrastructure, or stability. Sometimes that's true. But large portions often flow toward defense contractors, corporate subsidies, or financial rescues. And when repayment pressures build, governments rarely start at the top. They raise taxes, allow inflation to erode debt, or reduce public benefits. The debt may be issued for the people. The burden tends to settle on them as well. Consider bailouts. In 2008, financial institutions took excessive risks. When the system faltered, governments stepped in. Taxpayer-backed funds stabilized banks that had miscalculated. The explanation was that the system needed saving. And perhaps it did. But notice what happened afterward. Many of those institutions emerged larger and more concentrated than before. Losses were socialized. Gains, when they returned, were private again. The structure didn't collapse. It consolidated. Even pension systems reveal a similar tension. Workers contribute for decades believing funds are being set aside. In many cases, however, contributions are immediately spent, replaced with promises that future taxpayers will cover the obligations. It functions as long as demographics cooperate. When populations age and fewer workers support more retirees, reforms follow. Benefits are adjusted. Retirement ages rise. Inflation reduces real payouts. The promise remains. The terms shift. The pattern is consistent. Inflation is described as growth. Debt is described as investment. Bailouts are described as stability. Cuts are described as reform. Language softens the mechanism. In recent decades, the tools have become more technical. Quantitative easing, for example, entered public vocabulary after 2008. Central banks created large amounts of money to purchase bonds and stabilize markets. It prevented collapse. But it also inflated asset prices, stocks, real estate, bonds. Those who owned significant assets saw their balance sheets expand. Those without assets experienced rising costs without comparable gains. Again, capital shifted. Stealth taxation works similarly. Instead of increasing visible income taxes, governments rely more heavily on consumption taxes and inflation. When prices rise faster than wages, purchasing power declines quietly. It doesn't feel like a policy choice. It feels like economic weather. But weather does not write legislation. Regulatory capture adds another layer. Regulations are presented as protection, and often they do protect. But powerful industries frequently influence the very rules meant to constrain them. Railroads once shaped oversight bodies. Oil companies influenced energy policy. Today, finance and technology play similar roles. The public sees safeguards. Insiders understand leverage. War finance follows the same rhythm. Bonds are issued in the name of patriotism. Citizens buy them. Investors receive secure returns, backed by future taxation. The emergency passes. The debt remains. Complexity itself becomes a shield. Tax codes stretch thousands of pages. Budgets are filled with technical language. Financial instruments become difficult, even for professionals to unpack. When systems become opaque, accountability weakens. And when accountability weakens, redistribution can occur quietly. Why does this matter now? Because these mechanisms are not historical curiosities. They are active. Inflation affects savings. Debt continues to expand. Bailouts remain policy options. Monetary tools are deployed whenever instability threatens markets. The structure adapts. It rarely disappears. The point is not that every policy is malicious, nor that governments exist solely to extract. The point is structural. Financial systems prioritize their own continuity. States protect their solvency. Institutions defend their stability. If costs must be absorbed, they are often distributed broadly rather than concentrated upward. History shows this repeatedly. Rome debased coins. Monarchs compelled loans. Modern states inflate and borrow. Different eras. Similar mechanisms. The harsh reality is that many people never examine these patterns. Inflation feels normal. Taxes feel inevitable. Bailouts feel technical. And without historical awareness, repetition is hard to recognize. Financial education is not about paranoia. It is about pattern recognition. When a stimulus package is announced, ask who receives liquidity first. When inflation rises, ask who benefits from debt reduction. When regulations pass, ask who helped draft them. And most importantly, build resilience. Diversify assets. Think long-term. Avoid assuming that official language reflects underlying incentives. Systems are designed to preserve themselves. History does not repeat in identical form, but it does rhyme. The mechanisms that strained Roman citizens are not identical to modern policy tools, but the logic shifting burdens, consolidating advantage, remains familiar. The only real variable is awareness. If you understand the pattern, you are harder to surprise. And in financial history, surprise is expensive. If this perspective was useful, consider subscribing. We'll keep examining the structures beneath the headlines.